In recent years, the United States has taken a bold step in reshaping its trade policies by imposing tariffs and levies on a wide range of imports. These measures were introduced as part of a larger strategy to address what the U.S. government perceives as unfair trading practices, currency manipulation, and trade imbalances. While the immediate effects are felt in the U.S., the global economy is also undergoing significant shifts. Today, we'll explore the consequences of these tariffs on both the U.S. and the world at large. In 2025, the U.S. introduced a blanket 10% levy on all imports, targeting everything from electronics to clothing. Specific countries like China, the European Union, and Japan faced much higher tariffs, with rates ranging from 20% to 45%. The goal? To level the playing field in global trade and encourage domestic production. Let's start with the immediate impact on U.S. businesses. Companies like Apple, Nike, and Gap, which rely on global supply chains, are already feeling the heat. Their costs are going up as they face tariffs on imported materials and finished goods. The result? Higher prices for consumers and potential cuts in profits for major corporations. In fact, pre-market stock losses have already hit these companies hard, with stock prices plummeting. For consumers, this could mean paying more for everyday products, from clothing to electronics. For investors, the situation is creating volatility in the stock market. But the ripple effect doesn't stop at the U.S. border. The world's global supply chains are feeling the strain as well. Many industries, especially tech, apparel, and automotive, depend on parts, materials, and finished products sourced from countries like China, the European Union, and Japan. With tariffs making these imports more expensive, manufacturers are facing higher production costs. For some companies, this means they'll have to shift production or even raise prices, potentially reducing demand. As the world's largest importer, a slowdown in U.S. demand could trigger a reduction in global trade. As U.S. imports become costlier, global trade volumes begin to shrink. In fact, countries that rely on exports to the U.S., like China and the European Union, may see a decline in demand for their goods. When global trade slows down, so does economic growth, which can have a domino effect on jobs, wages, and overall prosperity around the world. In countries where industries depend on U.S. consumers, tariffs could result in lost jobs and economic hardship. And in a globalized world, these slowdowns don't just affect the nations directly involved, they reverberate through the entire global economy. Next, let's talk about currency markets. With tariffs altering trade patterns, we can expect currency fluctuations. Countries with large trade surpluses like China may see their currencies depreciate, while the U.S. dollar could strengthen as imports become more expensive. With tariffs altering trade patterns, we can expect currency fluctuations. Countries with large trade surpluses like China may see their currencies depreciate, while the U.S. dollar could strengthen as imports become more expensive. This dynamic could cause inflation in the United States as consumers face rising prices for goods. For emerging economies, it could make their exports cheaper, offering a potential opportunity to diversify trade away from the U.S. market. Geopolitically, U.S. tariffs are stirring tensions. Trade partners like China, the European Union, and Japan are unlikely to take these levies lying down. We're already seeing retaliatory tariffs and diplomatic wrangling over the terms of global trade. What's more, smaller nations caught in the middle may have to navigate new trade alliances or risk being sidelined in an increasingly fractured global economy. As countries seek new markets and trade partners, we could see the reshaping of global alliances. For instance, China might look to deepen ties with emerging markets, while the EU could focus on strengthening intra-bloc trade to reduce reliance on the US. The uncertainty created by US tariffs also has a huge impact on investment patterns. Investors might start pulling out of industries most affected by tariffs, such as tech, manufacturing and consumer goods, and look for safer havens in less volatile regions. In the long term, countries may adjust their investment strategies, seeking to diversify away from the U.S. market to mitigate risk and safeguard growth. The U.S. tariffs and levies have undeniably created ripple effects far beyond its borders. While the U.S. may seek to protect its industries and reduce its trade deficits, the global economy is experiencing shifts in trade patterns, investment flows, and geopolitical alliances. The key question remains: will these tariffs spark a long-term shift toward protectionism, or will they encourage countries to adapt and find new ways to cooperate in a rapidly changing global marketplace? Only time will tell. Thanks for watching. To stay updated on the latest economic developments, make sure to subscribe and share your thoughts in the comments below. Until next time, stay informed.